market doesn't always get things right, especially during the heat of earnings season when there's simply too much information for anyone to process all at once. Just look at two of the children of General Electric, GE Aerospace and GE Vernova, two of the best performing stocks of the year, up more than 80% apiece. Both companies reported terrific quarters, but both of their stocks initially sold off before rebounding dramatically from their lows. I want to walk you through what's going on here because these two represent very important parts of both the real economy and, yes, the data center economy. Why don't we start with GE Aerospace, which makes jet engines along with all sorts of other airplane components with a huge maintenance and repair business that's incredibly lucrative. When GE Aerospace reported on Tuesday morning, they delivered a clean top and bottom line beat, stunning 26% organic revenue growth. That growth was driven by better than expected results in both their commercial engines and services divisions, as well as their defense and propulsion technologies business. In fact, management was so confident in these results that they raised their full-year forecast pretty much across the board. To me, this was an amazingly impressive quarter. I read it in the morning. I said, around about 6 o'clock, I said, look at this thing. This thing's going to go nuts. But Wall Street had a more mixed reaction than I did. After rallying a little less than $4 on Tuesday, the stock then gave up all that and more yesterday before rebounding $8.50 today. So which was the right move, the rally on Tuesday and today, or the decline yesterday? While there were some concerns about GE Aerospace's implicit guidance for the fourth quarter, I think that's mainly management being conservative. On the other hand, there are a ton of positives here. In fact, I could argue that this company, stewarded by Larry Culp, who's such a great executive, may be the best industrial report this year. For starters, the company's commercial engines and services business, by far the largest segment, put up some tremendous numbers. 22% growth in equipment revenue, while the services revenue shot up 28%. That was aided by a 33% increase in internal shop visit revenue. Keep in mind, GE Aerospace really cleans up with their services business because it carries much higher margins than selling equipment. That's how the commercial engines and services division grew earnings by 35%. I love a good maintenance business. I don't even care if you give away the darn engines. If you get that maintenance business, you can make a lot of money. Management now expects to see commercial engines and services revenue growth in the low 20s for the full year. Previously, they were guiding for a growth rate in the high teens. That's a real uptick. At the same time, GE Aerospace had lots of positive things to say about their supply chain, something that requires a lot of attention in this age of much higher tariffs. The company seeing its priority suppliers, the ones that are mission critical, continue to improve on their shipment targets. These suppliers shipped more than 95% of committed volumes for the third consecutive quarter. Very impressive figure and a huge improvement over a year ago. I think some of that was because of COVID. It's the hangover of COVID, very much underestimated. Now, you might be asking, how much can these supply chain improvements really matter? But management credited these improvements for the record leading edge aviation propulsion, or LEAP, deliveries they saw last quarter, up 40% year over year. LEAP is a family of turbofan jet engines, one of the company's most important commercial products. GE Aerospace expects LEAP to become the industry's most utilized narrow-body engine. People love those narrow bodies in the not-too-distant future, eventually surpassing the CFM56. That's made by a joint venture between GE and the French company Safran Aircraft Engines. But the real key here is not engine sales. Again, it's the engine sales create a large installed base that requires high-margin maintenance services. Because GE Aerospace can now reliably get their hands on their most important inputs, they'll be able to increase LEAP engine deliveries by more than 20% for the year, when previously they forecasted just something between 15 and 20%. That's major. In the end, both GE Aerospace and GE Vernova are poised to be winners from the president's trade war. Because when other countries decide to make nice with Trump by narrowing their trade deficits with us, they need to buy lots of big-ticket items to really move the needle. That means they need to buy aircraft. They need to buy turbines. Just this past quarter, for instance, Korean Air agreed to buy 103 aircraft from Boeing, many of which will contain engines from GE Aerospace. I think this is one of the best ways to play the incredibly robust bull market in aerospace and travel. Plus, it doesn't hurt that even with today's rally, the stock's only a few bucks higher than where it was trading before the latest quarter. You're practically getting this terrific quarter for free. All right, now how about GE Vernova, which we own for the Travel Trust? Once again, GE's old power business reported an excellent top and bottom line beat, spectacular organic revenue growth, rising margins. Most importantly, GE Vernova saw its backlog grow 15% year over year, up to more than $135 billion. The company racked up almost $15 billion in new orders. Remember, orders give you a direct read to the current level of demand for the company's products. Despite these numbers, though, GE Vernova's stock initially plunged 9% yesterday, before rebounding from its lows and finishing the session down 1.6%. Today, Wall Street reassessed again, and this stock shot up 3.3%. Now, that move makes sense to me. As I told you last night, GE Vernova reported a terrific quarter, and the stock only sold off because it had already run up dramatically going into the earnings because it's connected to the data center, and people love the data center because you need their engine, electricity, for the data center. As we told CNBC Investing Club members, there was just a lot to like here. Management gave us a ton of positive commentary about their $5.3 billion purchase of the remaining 50% of Prolec. That's their joint venture with the Mexican company makes equipment for the electric grid. GE Vernova's buying the entire thing. As CEO Scott Strazik sees it, this acquisition will bulk up the company's exposure to their fastest-growing segment of their power business, which is electrification. Remember, the grid is old-fashioned and can't grow the way it should without their equipment. It is hard to argue with that statement, as Prolec's largest product offering is power transformers, the kind that are used in the data center, alongside all sorts of other energy-intensive applications. At the same time, management says they're seeing significant investment in electrification to the point where GE Vernova expects their combined serviceable addressable market to expand at a 10% compound annual growth rate, eventually doubling in size by 2030. Yeah, that's a data center because this business had almost no growth for years and years and years. What else? This is a moment where there's a ton of speculative interest in nuclear power. I think too much, by the way. Those speculative stocks have been obliterated in recent weeks. GE Vernova actually builds nuclear plants. Make this one of the safest ways to play the theme, even if it's going to take a long time before any of this plays out, simply because building a new nuclear power plant can take more than a decade. But I think we're going to begin to hear a lot more about what's known as small modular nuclear reactors in the next 2 years, and that will make people realize if you want to invest in the concept of nuclear power, well, then go buy the stock of GE Vernova. Plus, while the company's repurchased $2.2 billion worth of its own stock so far this year, they say they'll continue to buy back stocks on an opportunistic basis as they believe in, quote, there is incremental value embedded in our stock. Well, it doesn't really get that much more bullish, does it? Here's the bottom line. When two of the children of General Electric reported this week, the market got them both wrong. But today they came roaring back. I'm betting that GE Aerospace and GE Vernova are ready to run, and that today's rallies were the ones that mattered. Mad Money's back after the break.
Coming up, Big Blue beats again. So why is Wall Street bailing? Cramer's revealing what investors are missing when it comes to IBM's results. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.